Good morning, folks, and welcome to another one of my videos. So today I have two pairs on watch, and once again that is one of those pairs is pound CAD, and today I have got euro dollar on watch as well. So let's break these pairs down for you. Let's give you my thought process. Let's tell you why I'm looking at these pairs and what I will be looking for from them. Of course, it is nearly Christmas, so the liquidity may slow down a little bit, but we shall see. If it slows down, it slows down. But one of the things that we need to do as traders is keep ourselves in the loop, keep ourselves sharp. And one of the ways we do that is to keep up with our processes, keep up with the things that we do on a day-to-day basis throughout the year. One of the things that people do in December is they get sloppy and they take their foot off the gas. And of course, if you do that, then come January, you will be a little bit out of practice. So even if I don't place any trades, I'm just trying to keep sharp and keep in the loop, keep up with the things that I do on a day-to-day basis. So pound CAD, why am I looking at this? Well, you can see on the higher time frames, if we zoom right out, you can see we have a little dinosaur there, implying that this is the beginning of time, at least where Forex is concerned. But you can see we have an all-time low, okay, and we came close to it many times. We come down fairly close to it, come down again, push all the way back up to here, tap into this liquidity, which was the causation of this sharp sell-off. We tap into that here, we scoot back round to collect more orders, come down, near miss to this area. And then it's no surprise to me that once we near miss such a significant area of value, it's no surprise to me why price moves sideways for as long as it did, particularly with a pair like pound CAD. We then tap into that all-time low. So there would have been a lot of FOMO in these buy moves here, okay, because a lot of people would have been looking for it to get to this price, and a lot of the time people think they attach themselves to the market. They think the market is going without them. The market is neutral. The market does not care what you are doing. It's not purposely doing things unless you're trading something with a very low liquidity, which can be manipulated. But that's another story for another day. The market does not care what you are intending to do. The market is just doing what the market does. Okay, so there would have been a lot of FOMO in here. And the people that are patient would have been waiting for it to get to here. People that are patient, like myself, okay, it finally taps below there. I'm sure the media would have gotten hold of this and they would have said pound CAD at all-time low. And of course, the brokers would have put out news such as that because they want you to sell. They want you to think it's going to keep going. They want FOMO to kick in. They want you to think, oh no, I missed out, all-time low. Imagine how much money I could have made to the downside. So people start selling into the lows a lot of the time because of FOMO, and they've heard the news that pound CAD is at an all-time low. Other times because they're too zoomed in. They're selling it because they fear they missed out, and they're not aware that they're trading into a low because they're camped out on the lower time frames. A lot of people think to themselves, I remember when I first started trading, a lot of people think, oh, the market moves more quickly on the lower time frames. Surely that means I can make more money. So they camp out on the lower time frames and they don't realize that they're trading into lows such as this. Whereas the bigger players are camped out on the higher time frames to start with. They do top-down analysis, as I do, okay, and they think, well, if it drops below here, this is a bargain, okay? If you go into a shop and there's something, I remember it's just come to me about 20 years ago, there was a guitar that I wanted. I'm a guitarist. I used to be in a band, and there was a guitar in this shop, and it was always it was £729.99. I remember that, and I couldn't afford it at the time. And I kept everywhere I looked. I looked in music magazines, sometimes on the internet, I think, and it was always £729.99. And then one time I found it in a guitar shop in the back of the NME magazine. Um, there was an advert at the back, and it was by the Hanwell Guitar Shop in London, and they were selling it for £485 with a hard case thrown in. And I thought, wow, bargain. Okay, same thing here, bargain area of value for a buy. Okay, price then, so the bigger players get involved, and then we see that impulse correction continuation, which is the natural ebb and the flow of the market. You can see that price each time comes down, leaves a footprint. We then tap into that footprint and price goes. We then leave another footprint. Price comes down. it near misses. What is this near miss? Well, we don't know all of the reasons for the near miss, but we know one of them will be FOMO. So there would have been a lot of FOMO in here from people that were waiting for it to get here. But of course, these orders usually need to be filled before price can move to the upside. So, and especially as orders, if it doesn't tap into this area, then there will be orders being placed here whilst people are trying to buy this, which is dragging price down. We then tap into that area, then price moves to the upside. You can see, if I just remove all of that, you can see that we also have just a touch on it, a near miss here to the upside. So if price comes close to an area but doesn't tap into it, that gives me a clue that this move is likely to take out this near miss and take out the high that we near missed to. So that is my higher time frame target. Okay, so now as we drill down, I'm just looking for entries on the lower time frames to try and ride that wave, ride the wave of the bigger players up to that higher time frame target. I've only got my arrow pointed to here just for simplistic reasons, just because that would be I would likely, if I was going to hold this, I can't envisage me holding it for more than a move up to here, just because by that point you would be running a significant profit, and this would be an area where I would expect a lot of profit taking and some sharper pullbacks, and I wouldn't be likely, it wouldn't be likely that I would hold through that. Okay, so that's why I've got my arrow there. And you can see here as well, we also have near miss to here, near miss to here. Okay, we tap into this area, break below, and then we see those impulse correction continuations. What happens again? Price leaves a footprint. We come all the way back down. We're tapping into that footprint, okay, which is potentially an area of value. You can see that price consolidated here. What does that mean? That means there's volume here. If there's volume here and we tap into it, that may be the causation of that move to the upside, because we would have triggered all that volume, okay, taking it out. The volume that was dragging price down may now be triggered, or a lot of it will be triggered, meaning that we could be seeing a move to the upside. We are consolidating at that area of value. So by volume, I mean, you can see that there was a lot of volume here, and also when this volume was triggered last time, it was the causation of this move out of this volume all the way up to here. Okay, so but rather than get myself trapped into trades, which is what you can see many people do, they trade within ranges like this, which are not at an area of value, and you can see there's just traders fighting it out at areas of value which are not, high areas of value, whereas this potentially is. So with that in mind, I don't want to get involved in, for example, I don't want to get involved in a trade in here. If I was to try and get long here, I could be tagged in, tagged out, and then price does something like this. This becomes a bear flag. We push lower, and then this sequence to the downside continues. So how do we mitigate the risk of that happening? Well, rather than get trapped into what we call noisy trades, okay, those of us who trade the Falcon strategy, what are we looking for? Because you can see this is just consolidation. There's no real structure to this. When there's more candles within a piece of structure than there is black space or white space, if you're using a white background, this is just consolidation. So what are we looking for is price to blast above all of this, okay, and then I'll be looking for a consolidation afterwards, which is usually the bigger players in the banks stacking their orders for the next wave to the upside, and then all of this volume that has been built up in here will potentially be the catalyst for a move to the upside, especially when we've tapped into all of this volume here. Okay, so just trying to pay a bit more attention to volume. So I have an alert set just below here. If this alert does not trigger that you see on the right, then obviously we must be nowhere near this ray line which I've got on there, and nowhere near price breaking above and forming that consolidation. But if we do get the consolidation, if we do blast up here impulsively, okay, suggesting that the bigger players are getting involved, and then we get the consolidation afterwards, then I would be looking to get long on the break of a flag such as this, or within it with what we call a risk entry, which would be something like that. And then even if we only got the reduced risk entry, I would be able to manage it up to this first inflection point. Notice this is a sharp move where there may be volume. okay, because it was the causation of the move which broke below this and tapped into this area. That would be a solid first target, and I'll be able to manage the trade for about 4.5 to 5%. And if that alert does not trigger, then I will not be looking to place a trade. So that is pound CAD. Of course, yesterday, where were we yesterday? Thursday morning. Yeah, this is a prime example. Just to touch on it, this is really important, right? Remember yesterday I was looking for a break above here and a consolidation. If you're watching my videos, I was looking for that, right? Why was I waiting for the consolidation? Well, by waiting for the consolidation, as I said in yesterday's video, I was mitigating the chances of this happening, which is exactly what happened, okay? So you see a prime example here, if you're new to the way we trade, of why we wait for the consolidation afterwards. Because if you literally just wait for price to break above, or you waited for one candle, price can just go straight up, trap you into the trade, and then straight down, and then it just continues going sideways. Okay. So the consolidation afterwards is the key component to ensure that we don't get trapped into a trade which literally just breaks above and breaks straight back in. Okay. If it consolidates sideways, it generally means that price did not find enough liquidity here to send it back to the downside. Whereas if it just taps above, then it can retrace just as fast because it has literally just tapped that liquidity that was there and then moved to the downside. So hopefully that makes sense. And I'm going to leave that on the chart. Euro dollar is a slightly different one. This is kind of a counter trend play to some extent. If we just zoom out, okay. So on the higher time frames, I'm looking for a move to the upside because you can see longer term, I should say, right? So we tapped into this area, this last exchange of liquidity where there was volume sat, which caused price to break to the upside. And we tapped into that area by way of a 1, 2, 3 touch structure, which had a middle section, giving me a clue that this is a completed move and that we're likely heading to the upside to, potentially at least take out this area and potentially move a lot further and start tapping into these highs. Whether we tap all the way up to here is another matter. But we've got a 1, 2, 3 touch structure which taps into that exchange of liquidity. Okay, and what do we have here? If we just separate the structures a little bit, we then have, okay, so these are psychological patterns that we look for. We tap into this exchange of liquidity, which was the cause of that sharp runoff. What do we have? We have the second touch is a near miss to that area. Okay, we near miss. This is the FOMO channel. Then we have a 1, 2, 3 last leg, which breaks above, catches people the wrong side of the market who start buying here, and then it moves to the downside. We have a near miss here to this low. So this was a lot, there would have been a lot of FOMO in here. Eventually we tap into that area that we near missed to and we move to the upside. Okay. So as we draw down, so there's no need at this moment in time. If we just, let me just draw down a second. So as I draw down, okay, so we tap that area. There's no need for price to come all the way back down there. We tapped into this sharp area, which was the causation of this move. We tap into it, we sell off, but we come back up in suggesting that we may there may be more orders in this area for a potential short-term move to the downside. And the reason that makes me think that is because we scoop up, we near miss to this area, okay, and then we move up by way of a 1, 2, 3. These 1, 2, 3 waves are generally completed moves, okay. But what have we done again? We've kind of near missed. So if we kind of separate the structures, we can kind of see that this is one structure. Okay, and we appear to have what may be like what we call an ending structure. So we may get something like this. And what makes me think that is the fact that if you look how price has moved down, it's moved down correctively. This looks like another FOMO channel for a potential move up to give us that kind of 1, 2, 3 to tap into that area. And notice that I've only got my arrow pointed to here, and you might be thinking, well, why is that? Okay, well, if we just quickly look at the DXY, I'm just going to show you this on the if we just zoom out a second. Okay, so on the higher time frames, we've tapped into all this liquidity and we've pushed down. I'm anticipating a move down to here. Okay, if we look at the lower time frames, you can see that we left a hook point and we've near missed that several times. we kind of near miss to here, this near misses to here, and this to me is just looking like a middle section to tap into this area, to push up, to tap into this sharp hook point that we near missed to for that longer term move to the downside. Okay, now if that was to occur, if this move to the upside was to occur, that would mean that euro dollar would be selling off, right? Okay, so as this is going up, euro dollar is selling off. Now, if we tap into this area and the DXY sells off, then euro dollar will be going up. Okay, that's because the DXY is the inverse of euro dollar, right? So potentially, if you look at this on the flip side, if I just flip this upside down, if you see what I mean now, right? This is euro dollar flipped upside down. So if they're moving in tandem with each other and DXY does what I've just suggested it might do, then we may be tapping into this area and potentially this hook point, which is kind of the flip side of what the DXY is doing. Okay, so this may be a shorter term move before euro dollar then moves to the upside like that. Okay, so that's why I've only got my target there. Hopefully that makes sense. So with that in mind, what I'll be looking for from this pair, if I just take this off the chart, what I'll be looking for is for price to tap into this area here. Okay, so last time when liquidity was exchanged here, it caused price to break out of all of this volume. So we have volume there, and last time that volume was triggered, it caused price to break out of all of this, suggesting that there may be a lot of volume there this time. So if we tap into the area, we get the push down and the flag, then I will be looking to get short on the break of the flag or within it. And if we reach that target area, this is where I would actually set I would use the Fibonacci tool, okay, and I would measure it from here to here, and I would set a take profit at the 90% mark. And you might think, well, why the 90% mark? Well, what do we know? Okay, a lot of people who catch a move like this, one of the things that people fear is they fear that price is just going to reverse at this area. So that some of these people start closing their positions early out of fear that price won't get all the way here and it will just reverse early on them. Other people are looking to buy here. And of course, as we know, as I've explained from the near misses, they get FOMO and they jump in too early and then price pulls back steeply. Okay. And then a lot of the time these people get washed out anyway. But so what I would be doing is I would set a take profit here, which would, so when there's quite a lot of profit on the table, what I'll generally do now, this is a new part of the Falcon Mechanics modules within the Falcon community, of which I'm a member. Okay, and when we have these kind of big ranges, and we're not looking to hold, it's more about when you have these big ranges that price can pull back and you don't want to leave too much profit on the table. So what I would do is I would set a take profit at the 90% mark, which would be there, and then that would give me a profit target of 7.33%, which also makes sense leading into Christmas. I don't want to be holding trades through Christmas when the liquidity is lower. So that is what I would do. Okay, so that is euro dollar. We shall see what happens. I have an alert set to see if we tap into that area of value, and if we do not, I will not be looking to place a trade. You can see that price has been moving down correctively, and it appears this may be the move up now that we're seeing this little bit of momentum. Maybe the momentum that takes us above here or taps us into that area. We shall see. But that is what I'm going to be looking for today, folks. I will be back with another video next. Where are we? It's Friday now, is it? Yeah, Friday. So I will be back with another video next week. It's unlikely that I will place a trade next week just because the liquidity will almost certainly be lower, but we shall see. If one shapes up, we may get an in and out move that we can capitalize on. But thanks for watching, folks. I hope you've enjoyed this video, and I will see you again. Have a great weekend, and I will see you again in the next one next week. Have a great Christmas as well, and have a great day. Speak to you soon.